kind of the definition of an uptrend is oversold conditions hold and the trend resumes. And the definition of a transition or a downtrend is oversold conditions just get more oversold, right? So they're holding, which is good. So now the next question is do we, if you kind of think about that sequence of what is an uptrend is a sequence of higher highs and higher lows, right? Okay, well, we just put in a low, hopefully, and now you have to go on and make a higher high. And so if you don't make a higher high, let's say you rally up to the 50-day moving average and then things roll back over. I mean, that's a sign of potential trend transition. So yeah, I think I'm never worried about the first oversold condition, right? And I know a lot of people want to call a top and they want to, they got it, and you're like, okay, great. So for every top that we have, you've called 10 tops, and you're sitting on a compound return of 3%. Just stop already. Just stop. That's no way to run money. That's no way to accumulate wealth. The right thing to do is you wait until you can see the whites of their eyes. And that's essentially, you fail to make a new high and you undercut a low. Now we can start talking about, are we transitioning out of trend and do we need to take more defensive actions? This whole notion about, I'm gonna call the top and I'm gonna forecast it and I'm gonna get it right, please. There's, they say for a very specific reason, on Wall Street at one end there's a river and on the other end there's a graveyard. It's full of those people.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Black Friday, November 28th, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlick.
Happy Thanksgiving, everybody. Nice to see everybody back. Jeff, sorry about your Lions.
They might not make the playoffs. I always hate to say the we because I have nothing to do with the team. So I always feel like when you say we, it's a little presumptuous that somehow you're a part of the whole organization when really you're just a bystander. But they might not make the playoffs.
That is, if you actually look around the league now at who's got the best records, some of them are shocking, right? I mean, the Colts, really?
Right, yeah. Patriots, where'd they come from, right?
It's unbelievable.
They've had...
I was at Bloomberg Studios not too long ago, and they were reading the sort of morning rundown news on the radio. And normally this guy has like the perfect radio voice, the perfect voice for someone who like reads.
Oh yeah, what's his name?
I forget his name, but it's just
it's so good.
It's the perfect radio voice. Yeah. And even he was like, and in other news, the New York Giants lost. And even he started laughing, and it was so perfect. It's like, yeah. Anyway.
Hey, and Franklin's going somewhere, isn't he, Pavs?
He's going to Virginia Tech. As somebody who has a graduate degree from the University of Virginia, it's just another reason not to root for Virginia Tech, in my opinion.
There you go. Well, I mentioned Black Friday. This does, for those that can't remember, kick off a series of days and weeks. Black Friday, Small Business Saturday, Cyber Monday, which kicks off Cyber Week, Travel Tuesday, not to be confused with Giving Tuesday, and then finally Digital Wednesday next week. And that's all, right before we get into the ones that, get around Christmas and the New Year. A lot, as I said, going on in consumer land. This typically with all this stuff, you'd think with the seasonality that causes a nice backdrop for the overall market is not, Jeff, good for consumer discretionary stocks. Is that right?
That is 100% right. It's so since 1960, if you look at the S&P 500 consumer discretionary sector, there's only a 38% chance or probability, historical probability, not forward probability, of positive returns. And that average is probably about negative 65 basis points relative. So that's obviously not good. And when you look at the median, it's about I'm sorry, that was the median. If you look at the average, it's about 50. So the median is actually worse than the average, which says your kind of traditional outcome tends to be a little worse. So 38% probability and again, that's relative. So that's going to be versus the market. So it's probably a positive absolute return. It's just a relative underperformance. But that does certainly fly in the face of, I think, conventional wisdom, which is, hey, if I'm out shopping for Christmas, Hanukkah, and insert your holiday here, then it must be good for these consumer names. And it actually isn't for the month of December. Interestingly enough, though, if you roll that into January, February, and March, which is the best month for outperformance of the discretionary names, it actually does pretty well for the first quarter. So you could make a seasonal case that you want to buy the dip, but not buy here for the December returns.
And that's coming literally on the data from this past week that suggests that the consumer is not all too happy.
No, that's right. I mean, the consumer hasn't been happy for a while. This is the so-called vibe session, but at the margin, it's about what's the direction, and the direction of travel for consumer sentiment is lower, not higher. I think across a broad variety of sort of traditional indicators that you would typically look at going into the holiday shopping season. I mean, consumer confidence is down against last year. The unemployment rate is up against last year. Disposable income is running somewhat weaker than it was this time last year. Even gasoline prices, right? I mean, the administration has been touting gasoline prices quite a bit lately, but when you look at it, retail gasoline prices, pump prices, are more or less unchanged. It's only, I think, down maybe about a few cents compared to last year. That's not really a big driver for sentiment, obviously. And for a lot of people, their utility bills are up a lot relative to last year because of the AI data center build out. So I think the traditional kind of frameworks that people use to kind of figure out like what's going to happen for the holiday shopping season. I mean, it at best probably points to a pretty choppy consumer. From my own personal perspective, I mean, Zcash is down about a lot over over the last 24 hours. So we're definitely the kids. Yeah, I mean,
how are you going to break it to Nick about Christmas?
Normally, I would put like chocolate or something that, like Ferrero Rocher in their stockings, but at best, I think the candy canes in bulk are probably going to be what they get this year.
We're going to get bailed out, maybe though, by the Fed come December. I mean, it's amazing what's happened in 1 week, right?
I mean, yeah, I mean, it started with Williams. He kind of saved it, and then Myron has been kind of making the media rounds, basically saying that he'd vote for 25 if he was the marginal vote. So that the risk of him like threatening to go 50 and blowing up the whole 25 basis point cut like that, to the extent that was a risk, it's no longer a risk. So expectations have kind of solidified for a cut in December. But it's not really about whether they cut in December or not. I mean, maybe that. Yeah, I mean, there's certainly a lot of people that think that's a big deal. I think that a lot of them are sort of in the. It does feel like a lot of the crypto space, like if they don't cut, it's going to be a mess. The issue for the economy is the path of easing going forward, and if all you're doing is cutting in December and then signaling a meeting by meeting approach going forward, how does that work out exactly? Like if that's the best the Doves can do. So what you're saying is, okay, the data comes out. That data is actually not a snapshot in time. It's a snapshot from 8 weeks ago. And then let's say it's bad. Then what, 2 weeks later, then you cut? Like, so you're just responding to data that's in the past. Like it's just a recipe. If the economy is in fact slowing in a more material way, it's just a recipe to fall further and further behind the curve. Right. So, and that seems to be the best that we can get right now is that they cut in December, but they're not going to signal a path of easing up front. And, I think it's really interesting because it's really tough to come up with a case for higher inflation right now, in my opinion. I mean, I know a lot of people point to tariffs and expectations and so forth, but, I really just don't see it. I mean, at the end of the day, the unemployment rate has been going up and home prices have been going down. And historically, like, when has that combination ever really resulted in a reacceleration of inflation risk? So I do think there are problems with the way the Fed is going about this. I've argued that it's either going to be a cut, it's either going to be no cut or a hawkish cut, and it seems like we're getting a hawkish cut. But I wouldn't really break out the pom poms just because they're cutting in December.
And do I really care about Fed funds? Jeff, you had that report out this past week to clients about the importance of the 2-year yield versus Fed funds as an indicator of the S&P and the direction of the S&P. So we get all wrapped up around the Fed, but shouldn't I be looking at 2-year yields? Isn't that what I care about?
Yeah, look, if you want to do it by the math playbook, right, you'd look at 2-year yields, which, I mean, keep in mind, 2-year yields are, an amalgamation of expectations, right? And so the Fed probability path is baked into that, the dot plot, all these things that we talk about. So that is embedded in the 2-year yield. But if you look statistically at, the performance of the 2-year yield over the last 3 months. So historically, look back over the last 3 months, and then use that as a guide or a proxy for what the S&P is going to do, or sectors or whatever, going forward the next 3 months. Statistically, Fed funds is a zero. It doesn't come in as being, meaningful. But the 2-year yield actually is statistically significant, right? So the 2-year yield says, or the data says, that the 2-year yield, again, embedding the expectations of the Fed and the longer term path, is far more influential on S&P returns. And the good news there is that it's been in a downtrend. It continues to be in a downtrend, and it continues to suggest, an easier path forward in terms of rates. So I think that's good news. But that's not to say that we don't, look at the Fed funds. I mean, keep in mind, and I think this is important. Now, this is partly, one of the hangups that we had last week, which is the market was so embedded on what was happening to the Fed funds. We went from, basically starting the week a week ago at a 30% probability of a Fed cut to, I think we ended the week at, 70, right? So all of a sudden you just kind of swung. And keep in mind that 50-50 is really kind of that dividing line that ends up being important, right? Right now I think we're at 88%, something like that, 84%. But the 2-year yield that entire time was kind of steady Eddie. It did move a little bit, but there was no way, shape, or form that it was changing the trajectory. So I think that's important. And Neil's 100% right. I mean, the equity market rally, which did take place, by the way, and I think this is really important because we talked about it. It took place precisely, this didn't happen Monday. It didn't happen Tuesday. It happened on the close Thursday of last week, precisely at the point where the SPAC index was oversold, the NASDAQ equal weight index was oversold, semiconductors were oversold, Bitcoin was oversold. All these things were oversold, and lo and behold, Williams came out and made some comments that completely flipped the narrative around the expectations for rates. I would actually almost say at this point, I mean, if Neil thinks that the data or the Fed is still kind of walking the line, and the market has now taken this to 84%. Maybe that's not, maybe the expectations for the market are too high now, right? I mean, is the market now saying, hey, we're almost assured of a rate cut, and if Neil's still in the 50-50 camp and they don't do it, that could be a problem for equities as we get into it.
Well, I don't think they don't do it. It's to me, it's not about what they do in December. It's about what they signal going forward, right? Like, so if they cut into, so for example,
I got you. Yep.
Right. Like if they cut in December and then they say, we think we're done, or we're going meeting by meeting, like, what does that do to market expectations? Like you're basically telling everyone you think you've achieved risk management, and now you need to wait to see something break before you cut more.
So the market right now has the next kind of assured Fed cut by June, right? It's about a third for January, third for March, third for April, and then assuredness at 62% by June. But I mean,
yeah,
listening to you would say that's
can happen between now and June.
Right. You'd say that's a home run, right? I mean, you're 62% for June. You would be in the camp of it's going to be, probably closer to 80 or 90.
I think they'll probably cut in June, but by June, they certainly, I think they'll cut in June, but it's more about if they're waiting until June, like how much are they doing at that point in the second half of the year? right?
Right.
Like that's sort of how I would think about it, because you're like I said, it's just like that step function, right? Like if you're waiting for some kind of permission structure in the data to give you the confidence that you can ease, then the bad news has already happened, right? And so in that case, now you're playing catch up, and I mean, that's not a good thing for the stock market, I don't
No.
think either. Yeah.
100%.
Does the
agree.
reaction of those indices that you were talking about, Jeff, the SPACs, NDX, EM, off those oversold conditions, is that a tell going forward, like what they do from here?
Yeah. So look, kind of the definition of an uptrend is oversold conditions hold and the trend resumes. And the definition of a transition or a downtrend is oversold conditions just get more oversold, right? So they're holding, which is good. So now the next question is do we, if you kind of think about that sequence of what is an uptrend is a sequence of higher highs and higher lows, right? Okay, well, we just put in a low, hopefully, and now you have to go on and make a higher high. And so if you don't make a higher high, let's say you rally up to the 50-day moving average and then things roll back over. I mean, that's a sign of potential trend transition. So yeah, I think I'm never worried about the first oversold condition, right? And I know a lot of people want to call a top and they want to, they got it, and you're like, okay, great. So for every top that we have, you've called 10 tops, and you're sitting on a compound return of 3%. Just stop already. Just stop. That's no way to run money. That's no way to accumulate wealth. The right thing to do is you wait until you can see the whites of their eyes. And that's essentially you fail to make a new high and you undercut a low. Now we can start talking about, are we transitioning out of trend and do we need to take more defensive actions? This whole notion about, I'm going to call the top and I'm going to forecast it and I'm going to get it right. Please. There's, they say for a very specific reason, on Wall Street at one end there's a river and on the other end there's a graveyard. It's full of those people.
Well.
You ready? Let's go. Let's go. You got me fired up now.
Not sure I got the right transition for that one.
Yeah,
but Steve,
you hit me with the Lions. That's the problem.
Oh
no! You know what? What else you hit me with? Just to go on. I knew this was going to happen. I flexed a little last week, right? Talking about who was number one in college hockey, right? We promptly get swept by Wisconsin, which, look, I love Wisconsin. The Badgers, they're great. A lot of my friends are Wisconsinites. I love the accent, the whole thing. Sorry, the whole thing. It's great. And now what happened? Michigan's number one, and we're number three. So that's why I'm actually that's it.
I was actually waiting to the end of the podcast just to divert you. But
psychologists always say somewhere it's your mother, right? For me, it's U of M. That's what it is.
Pavlick, overseas, there was some saber rattling. See, now you got me rattled. Japan, Taiwan. What's going on over there? And you got the USMCA meetings this week, I think, right?
This coming week. So with Japan and China, there's some concern, at least on the part of the Chinese, after newly elected Prime Minister Sanae Takeshi, I believe, Takashi, however you pronounce it, from Japan, suggested that any Chinese intervention there in Taiwan could be grounds for some Japanese response militarily. Obviously, Taiwan's a very sensitive topic for China. They didn't appreciate that. So you had Xi Jinping reach out to President Trump, ask him, I think more or less, to have the U.S. stay out, given that Japan's a strong ally of the U.S., and I believe apply some pressure on the Japanese Prime Minister to maybe soften the rhetoric there a little bit. And so I think, looking ahead, you have China's goal of having its military to have the capability to seize Taiwan, if necessary, by force in 2027. Doesn't mean they will, just want to have the ability to do so. And then I think sort of related to that, you have this question of the U.S. military commitment to defend Taiwan. And you have Taiwan purchasing about $40 billion worth of equipment right now to try to raise doubt amongst China's ability to execute that. And, does our commitment wane if we are successful in developing our sophisticated semiconductors here, as opposed to being overly reliant on TSMC? So I think there's a lot to think about there. With respect to next week, that is when The Office of United States Trade Representative is going to have public hearings as to the impact of the United States-Mexico-Canada agreement. This is ahead of next July's joint review, but they're going to have 3 days of hearings. They had originally been scheduled for November. They got kicked back. Some people attribute that to the government shutdown. Some people also believe there's just so much interest to give companies the opportunity to comment here that's why they needed to postpone it a little bit and actually allow for 3 days of this. So I think this sort of brings into focus, the topics as USMCA review heats up for next year. And so when you talk about Canada, Mexico, their exposure, look for some headlines around that.
And throwing a trial balloon up around Hassett being the Fed chair too. I know that's a little less in your wheelhouse, more Neil's, but how about that? Does he get it?
I mean, you can make a case for a lot of different candidates. I think the question is you have to probably use Myron's vacancy in January. That's the only vacancy outside of Powell's position as governor in 2028 that President Trump will have an opportunity. So you have to use that Myron vacancy to appoint somebody outside the existing Fed structure to be chair, the replacement there for Powell. And, you could see a scenario where he selects Hassett. Does that sort of weigh on Powell's decision whether or not to remain in the role as governor? You're also going to have this January 21st Supreme Court case with respect to Trump's ability to fire Lisa Cook. If the argument sort of suggests that the court may rule in Trump's favor there, that's probably going to weigh on Powell's decision too. And then the market will probably have an impact or a say too. How are they going to respond to the announcement if it is Hassett? And if all those things aren't going the direction that the administration wants, respect to a negative market reaction, the idea that Powell may suggest that he'll stay in his role as governor beyond his expiration as chair in May, are they going to be committed to Hassett, assuming he's the pick? I don't know. There's also the question of whether or not Bessent decides to take it. I think he probably learned a lesson from his campaigning for Treasury Secretary that maybe it's not in your best interest to show your cards early on. That prompted others like Howard Lutnick to make a play for the role and almost jeopardized his chances there at the time. So you could see a case for him to keep the cards a little closer to the vest this time and just sort of, say, I've done all these interviews. The president asked me to do it. I'm going to do it. Don't give your enemies opportunity to hurt your case for the job. If in fact he really wants it, I don't know.
Can you imagine if Lutnick was the Treasury Secretary versus Bessent?
Well, that's one of the considerations. If Trump appoints Bessent to Treasury Secretary, who's the Treasury Secretary? Would Lutnick make a play there? He did hire a bunch of former Treasury people. I know because I worked with them. There was always some speculation about that early on.
Well, if I'm looking at body language, I know Neil's got something to say here.
Well, I think there's a couple things. I mean, I think the first is the market narrative that just because Trump is able to push through like a Hassett, that doesn't automatically mean you're going to get dovish policy. What you will have is a very fractured Fed, right? Like the Fed is very divided as it is. And if you think it's tough for Powell to get a consensus around December, it's going to be much more challenging for Hassett to get a consensus for anything next year. I mean, you could easily see some periods where Hassett, who's someone that's advocating for cuts, has to go out there before the press and talk about decisions where they're not in fact cutting interest rates. So it would make for a very, very awkward kind of situation if he were to get the seat. I think it's going to be tough for anyone to get consensus, but I think it's probably especially the case for him because he's increasingly, accusing the Fed of being political and, making some very interesting arguments that I think wouldn't really hold with people, within the Fed itself. So, you kind of have to understand the institution and how it operates if you want to, affect the change you want to see. And, it's an open question whether Hassett is able to do that. If you're President Trump, I mean, why would you want to give Hassett up to the Fed? I think he's been a very good advocate for the White House, quite frankly, right? I mean, if you remember back when we had that really, really bad jobs number and Trump fired the BLS commissioner because the number was bad, within the span of 36 hours, Kevin Hassett had the entire financial community talking about how the survey collection methods were, not great, and how the response rates are low, and things we've all known for a while. But it's completely deflected the conversation from Trump firing someone because the number was bad too. Well, actually, it's the collection methods. I mean, it's a complete red herring. But why would you want to give someone? I mean, being able to change the subject quickly to deflect attention from the boss is an asset. So, yeah, I mean, I don't know. I mean, I think, look, if I had to pick, I would say Waller is my first choice. I think he's the first choice of most people in the financial markets. If I had to go with a second pick, I would say Bessent. I would say Bessent for three reasons. Number one, he has the confidence of Trump. Could you imagine being Kevin Hassett? Could you imagine? Every chance that Trump gets, he says, well, my first choice is sitting right over here. It's Scott. But he keeps telling me he doesn't want the job, which implicitly means that everyone else is number two. Okay? So he has the confidence of Trump. Bessent has the confidence of the financial markets. And frankly, I also think that, we know this is like a TV president, like he's always all about central casting and so forth. He talks about how Scott Bessent is soothing. He soothes the markets. He says this is all what Trump has said. Yeah, I mean, I think in terms of like getting bullied, I don't think that Scott Bessent is going to get I think in a way he almost preserves the independence of the Fed, because I think Trump is going to be way more deferential to him than Hassett. Stewie cannot be the chair of Stewie from the Family Guy cannot be chairman of the Federal Reserve. I'll never.
Does that make Larry Summers Peter?
Yeah, it'll never. I mean, I'll never forget it when Buttigieg was climbing in the polls, like back in in the last Democratic primary. Trump goes out there. He's like, he goes, Alfred E. Newman cannot be president. Well, by the same token, Stewie cannot be chairman of the Fed.
Wow. Well, a reminder to go to RenMac.com to see what else we do here at RenMac, cartoons included, or go to X and LinkedIn. We do a lot more on this at RenMac than just this pod and that stuff. So become a client. We have a lot of insight into what we're doing.
You know what else we have, Steve?
What's that?
I'm pretty sure it's up because it is Black Friday, right? This is the busiest, well, it used to be the busiest holiday, whatever, retail of the year. RenMac merch, MERCH, RenMacMerch.com. It's up and running. And we got some good stuff. We have one of the hats, the incognito canvas cap. So, you can hide like a movie star when you're out getting coffee in your local village so people don't know who you are. We've got, Run DMC type shirts. We got koozies. No, it's pretty good actually. So the big thing though, so this is 15%. So we are making no money on this. This is all cost, right? So we're selling things at cost with a 15% markup, of which that 15%, the entirety of it is going to Make-A-Wish, which is just a great organization. And we wanted to, offer our things because people are asking about them, but we wanted to do it in a way that was also helping a terrific organization and charity. So the Make-A-Wish Foundation gets every cent of the markup at the end of the year. So anyway, go to RenMacMerch.com for your holiday shopping needs this year.
There you go. RenMac.com to go find out what we do. RenMacMerch.com to see the.
Do we accept payment on that site in Zcash or
Zcash? Well, you know what? Let me look into that.
Harry, mailbag time. What do you got for us today?
Okay, good morning, everybody. We have question come from Nathan Schneider this morning. And his question is, aside from the risk of a recession, what potential developments in 2026 could pose challenges to profit margin expansion? That's it. Thank you.
So other than a recession, what kills profit margins in 2026? That sounds like a Neil Dutta question.
Well, the markets are basically, betting on a big productivity tailwind, presumably from the AI build out, and perhaps next year is going to be about whether that productivity tailwind shows up or not. So we'll see. I mean, that would be if productivity is, I mean, so far, I mean, productivity hasn't been particularly, any great shakes. I mean, it's kind of growing at a 1.5% pace. I mean, that's not bad, but it's, the kind of boom that the markets are seeing. It's not that either. So that to me would be something. Typically you don't see productivity go up alongside the adoption, right? I mean, it's usually a period after the adoption. So maybe, I mean, you could make the argument that perhaps the markets are getting a little bit ahead of themselves. Remember that the big productivity burst, it wasn't really in the 90s. It was actually the period after that, after the NASDAQ came under pressure and sank. That's actually, the productivity from like 2000 to 2003 was actually quite spectacular, even more so than I think than the late 90s. So.
You know what I think is a point to that, and you're spot on, Neil. By the way, it's almost like you need another generation to come in, right? So, are you Gen Z? What's your generation? Are you a millennial, Neil? I didn't hear you. Yeah, there he is.
Oh, no, I'm a millennial.
You're a millennial. All right. So it's almost like the next generation, because it's just part of their lives, adopts it and goes, right? Like are all of us on the pod, are we too old to really adopt AI and, use it in the efficient way? Certainly it'll help, but my mom uses Google, right? Is my mom going to use AI? Probably not. It's just, you kind of get set in your ways and this is how you do things. And it almost feels like you need a generational shift where people grow up, just like the kids with the iPhones, right? Like kids, now the iPhone is just like an appendage. And so, it's just kind of curious of that. Is that what ends up happening, that the preteens, teenagers now are going to be really the ones that take the productivity to the next level because that's all they've really known. And then once they get to working age, they're using that and implementing that in a way that kind of changes the entire game. And I think that's a really important point. And certainly there are going to be people, that are highly productive that will adapt, and, you don't need that from a generational standpoint. But for the type of seismic shift that you're talking about, I really do think it's almost, you have to grow up with that technology for that entire generation to adopt it and to make it, really what it is designed to do. We'll see.
Howard Mason, Howard Mason had that very comment, Jeff, in one of his presentations he was making, that first wave, we use AI for search, right? And then the next group uses it for productivity gains, and then the third use is really agentic AI. So it's like it goes in waves. So made that exact point. It's
well, you speak for yourself. I use it to predict baseball scores.
Well, yeah, that's true.
Highly productive.
I think there are two things from the policy perspective that I'd watch that could potential impact, I guess, for profit margins. One is the prospect of additional tariffs. I think that will depend on the outcome of the Supreme Court case, because Trump suggested he may pivot to other areas. I think there is a political reason to maybe try to reduce some tariffs for those consumer-facing items. You've sort of seen that already with the agriculture products. But in these other areas, these sectoral tariffs, my guess, are going to see expansion there. So that's one area to watch. And sort of related to those affordability concerns, it's this regulation with respect to mergers and acquisitions. So far, the Trump administration has been very encouraging, welcoming to deal making. But if the deal making starts to maybe be perceived as adding to affordability concerns in some of these consumer-facing areas, or in areas like healthcare, you might see the administration take a different approach. And so that would be something I'd watch for as well.
Thank you, Nathan, for that question. We'll get you a RenMac trucker hat out to you this week in time for the holiday shopping season. I'd also like to give a shout out to our own Chris Jennings. Chris runs our trading desk and was in a bad car accident this past week. He's on the mend, so that's good news, but I know he's listening to this. So Chris, to you and your family, get well for sure. A lot to be thankful for with your health. So let's look out for the new week, what we're looking out for. Neil, what are you watching this week?
Well, we're going to have the ISM data, and we're also going to have ADP employment. Remember, we're still kind of playing catch up. It takes a lot to kind of get the statistical agencies up and running again and the data out. So we're not going to get a jobs number, but we will get ADP and ISM. The data really are kind of, all over the place right now. When you look at ISM, some of the surveys have been better, but then, the Chicago PMI came out earlier this week and it was a complete train wreck. So it's really hard to know like what's going on. So we'll see. I mean, we'll just let the numbers come to us. The ISM has been kind of very sluggish for a while. So it'd be really weird if, it changed from that. I don't think it's really meant much one way or the other. We've seen an ongoing decline in manufacturing employment. The Beige Book was released. And again, I mean, there's a lot of enthusiasm for really strong GDP growth. But when you look at the Beige Book, which is a sort of report of all the Fed's business contacts, it is completely inconsistent with strong growth. I mean, it's, over I think it was half the districts saw outright declines in employment. I mean, that is not something that's typical when you have very strong growth. So, yeah, I mean, it's really odd out there right now. I do think, the big story going forward, as the data starts to come out, is that we probably see some convergence between employment and GDP. That was sort of the big macro discussion before the shutdown, because, you had this very strong GDP, but very weak employment. And, my sense is that you probably see some of that gap go away. And again, I mean, there's also a lot of little wiggles and squiggles in the data, right? I mean, you had the shutdown that probably affected some activity. Now that the shutdown's over, you probably get a pop in activity that probably sends some of the data points above their underlying trends. So, it's tough out there. But, ISM and ADP, the weekly ADP numbers that come out, sort of a new data set, they've been really weak. I mean, they show ongoing contraction in employment in the private sector. So,
and Neil, just side note, I know you had this coming out to clients this week about whether or not tax refunds actually boost consumer spending. You want to touch on that real quick?
Yeah. So, I mean, in client meetings, a big topic is, in terms of pushback, is like, oh, there's these big tax refunds coming, and people are going to go out and spend it, and that's going to save everything. But remember that tax refunds, they don't sustainably lift consumer spending. Okay. And really, like, what determines how much of the tax refund is spent, and the reason that's the case is because it's not a shift in permanent income expectations. But the real issue is, how are people feeling about their employment prospects and their income constraints at the time the refunds are being issued? If they don't feel great, guess what happens with the refunds? They don't really get spent. They get paid, debt reduction and so forth. So, it's really it's always been tough to make refunds work. I mean, I think if you're hanging your hat on refunds being like the saving grace for consumer spending next year, I don't know. I've never really seen that in my career. But I would just say that, it's really about how people are feeling about their employment prospects at the time the refunds are being issued that really matters. It's that income constraint that drives everything else.
Thanks. Steve, what are you watching this week?
So we mentioned the trade hearings there for USMCA, so Canada and Mexico. So that'll definitely be something to keep an eye on. I think the other thing to watch is Congress. They're coming back. It's a 3-week sprint. And I think you're going to see a lot of focus on the defense bill. And we're going to watch some of these related provisions that are being debated right now for inclusion. That is this outbound investment screen. That's respect to state moratorium on AI regulation and housing affordability initiatives as well. The other thing that I would keep an eye on as we think back to the end of the year is there's going to be a vote on Affordable Care Act subsidies. We're not sure yet how many votes or what they're actually voting on. And you have divisions, I think, still in both parties. Republicans are divided. There was a report that the White House was going to propose a 2-year extension with income thresholds, as well as some fraud preventative measures to try to win over some Republican support. I think there's a lot of pushback from Republican lawmakers to that. And there's still debate whether or not to try to shift some of the funds from the ACA subsidies to flexible spending accounts, health savings accounts. Again, maybe let some of these consumers spend this money elsewhere to get ahead of the election to address these affordability concerns. And Democrats are divided too. I mean, do you want an issue or do you want a solution? They may want an issue heading into the midterms, not to solve this. So when I think about who could be impacted here, you got to think about the health insurers that are exposed primarily to these ACA subsidies. So I suspect that will also continue to be a topic next week and probably the remaining weeks to the end of the year.
Jeff?
Well, I mean, it's done very, very well here recently, and it is a very good setup in our work is healthcare, right? So not quite what Steve's talking about, but biotechs and devices and life science in these areas that really look like they're making beautiful kind of almost generational turns, right? So the alpha generation in healthcare has been abysmal, as bad as anything we've seen in the last almost 70 years, over the last 3-5 years. So that's part of our SERM work, standardized excess return, which if you're a client, you can see that. And so seeing these big turns and then these relative breakouts as they come are just, they're really something to behold. It reminds me a lot of our call on China, our bullish call on China 2 years ago, kind of the same similar setup. And we're seeing that in healthcare here. That's I just say that because of what Steve mentioned. But what I'm watching is really the idea between cyclical and defensive. And if you look right now at the market structure for us with momentum, utilities and healthcare are the two top sectors. Those are two very well-defined defensive sectors, right? The good news is staples, which is probably the ultimate defensive sector, is also at the bottom of the ranking, so that's not participating. But utilities and healthcare have moved ahead of tech. They've moved ahead of industrials. They've moved ahead of discretionary. So to look at the market's messaging about whether the Fed is behind the curve or is kind of hitting it on the screws. I think that will be an important distinction. And right now, defensives are outperforming the cyclicals. And where we are on the market cycle clock, that shouldn't be happening. So I'm 100% in Neil's camp that the market needs a cut, and it needs more than one. And that's usually what happens in this zone is the Fed has kind of free reign to cut rates, and good things can happen. That's why the market's returns tend to be pretty good as we move lower. But they might end up being in that policy mistake part of the curve, right, where they cut once and say, oh, we're going to wait and see. To Neil's point, and I think that would be bad news. But continue to watch the cyclicals versus defensive. That's going to be on our list. And then to your earlier point, Steve, we did respond to the oversold condition. That's good. How do we do if we get into an overbought condition? How do we do at natural resistance points? Because if we don't just kind of blow through those without even thinking about it, then we are in a situation that is more distributive and less accommodating to the bulls as we enter 2026. So those are going to be things very nuanced, obviously, but those are going to be things that we're going to be watching.
Well, a lot to digest as we get into to next week and the first part of December. So we'll be back next week to talk about all of that stuff and more. Just as a reminder, follow us on X, on LinkedIn, on YouTube. If you like what you hear, go to renmac.com to become a client if you're not one already. And if you like what you see, go to renmacmerch.com to get some of the RenMac gear that we had up on the channel just a bit ago. So we'll be back, as I said, next week. We'll digest all this stuff. And until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlick.
Thanks, everybody. Have a great
See ya.
week.